All right. Hello and welcome. My name is Abbott, and you're watching the Easy Option Trading course. Thanks again for watching these videos. Really appreciate you taking the time to learn and watch about options with me. So let's get right on to it. In this video, I want to talk about the time to expiration. Remember, on option pricing, it relates to what gives you better or worse odds of making a profit and how much profit. And in this case, in regards to time value, which is a time value premium, it is a portion of the option's premium attributed to the value of time. So going back to whatever gives you better or worse odds or how much profit, in relation to the time value, as you increase your time to expiration, as you have more time in the option, the likeliness of making a profit also increases. Thus, the price of the option increases. Now, you may be wondering why the likeliness of making a profit increases as you increase time. Well, I did a little study with the SPY going back from January 29, 1993 to July 23, 2015. Here on the very first column, you'll see time frames of a daily and weekly and monthly. And then here is the average change of those time frames. So on a daily, it would be today's price versus yesterday's price. Weekly is, let's say, this Friday's price versus last Friday's price, and monthly is on a monthly basis. And then we have the standard deviation. The standard deviation, if you don't know statistics very well, which is completely okay, standard deviation in regards to stock prices is the higher the standard deviation you have, the more price movement there is within the stock. So you see on a daily basis, price movement is not very large. You see the average percentage change on a day-to-day basis is 0.04%, and it has standard deviation 1.19%. But as you increase the time from a weekly to a monthly, it goes from 0.2% to 0.8%. And also the standard deviation increases. So what that tells us is as you increase your time frame, there is more price movement that occurs. And if there's more price movement that occurs, there's a higher likeliness of your price target being met or reaching your price target. So hopefully that makes some sense. If not, I also have kind of a visual representation of it. So let's say SPY is trading at about $200 and you wanted to reach 202. And so that's a 1% move in the stock price. And you're looking at a 1 week time frame. Now, for it to reach 200 to 202, this is just a hypothetical situation. You'll see that the candlesticks or the bars are a little bit larger, and there is some erratic movement within price, just because there needs to be a large move on a given single day to move up to the 202 price. Now let's look at a comparison to a 2-week time frame. So we doubled the time. You can see that the price movement isn't as erratic as if it was just one day. What I mean by price movement is a price movement on a day-to-day basis. Because on average, we said that price moves only, was it 0.04%? You can see that this 2-week time frame is a little bit closer to the 0.04 than the previous slide of 1 week. Now, if you think about it, if you go from, let's say, 2 weeks to a month, you may see those bars get smaller. It's not to say on a random given day you can have a 1% move in the stock price, but on a day-to-day basis, it is highly unlikely that the price will move that much in a given day. So what my point I'm trying to get across is on a longer time frame, you can see price movement being less erratic on a day-to-day basis. So that being said, it is highly likely to reach the price target you are trying to reach, instead of a 1 week time period, short time period where the price movement needs to be much more erratic and a lot more price movement to reach the price target. So let's get some validation on the numbers of the price option of the options pricing. So here we have SPY on the Thinkorswim platform, and as you increase in time on the call side, you can see that under July, with 2 days to expiration, the 211 strike price, the price of the option is 77 cents. And as you increase in time, as you go down, you can see that the price of the option has increased. Let's keep going down, so all the way to 314. But inversely, you could also think about as you get closer to the time of expiration, the price of the option also decreases. Now, keep in mind that this is keeping everything else constant, and while keeping everything else constant, such as the strike price, the prices of the option will change as you increase time. Now, this would be a good time to introduce one of the Greeks. There are 4 major Greeks within option trading. But theta is one of them. Theta is time decay. And what time decay is, it's really the rate of decline in value of the option due to time. And when you see it on the Thinkorswim platform, it is the decline in dollar amount per day. So let's go over to the Thinkorswim platform really quick. Let's go here. I have S&P 500, so let's go to the trade tab. Let's try and type in SPY. We could try another one just for example. Let's try an Apple. Let's go with Apple. Something a little different. So let's say we go to the August 15 with 28 days till expiration. We're looking at theta here. If you don't have theta there, just click on theta and then you go to option theoreticals and Greeks and then theta. And what that does, that'll change both your calls and your put side as well. So you can see here, theta is negative 0.04. And what that is telling us is, given the status quo, meaning that everything else being constant, such as the price of the underlying and the strike price being the same, you can calculate that the option price will decrease by $4 every day, just for owning this option. As you can see up here, if you're up onto the 130 strike, you'll be losing $3 a day. So as an option holder, you can imagine that time is always going against you, because the closer and closer you get to time to expiration, the more money you'll be losing on a day-to-day basis. Conversely, if you are an option seller, you think about time working in your favor, because you'll be able to collect that money, that theta, every day, because you've sold it and you're having time work in your favor. And we'll talk about that in the upcoming videos. But I did want to note that theta is not constant throughout the life of the option. So here's a graph that shows the option value and the time remaining until expiration. So if you have an option that is 120 days till expiration and goes to 90 days, you see that theta, or time decay, is really small for that time period. Or not really small, just small. But if you go from 90 to 60 days, you can see that theta, or time decay, has increased. The rate of decline has increased. And from 60 to 30, again, the rate of decline has increased. And from 30 to 60, you see that it is the most rapid, or the rate of decay or time decay has been exponentially grown relative to the other previous days. So something to think about. Um, Also, want to give another representation, a study done by tastytrade, which is a financial network, tastytrade.com. They did a study on what theta is. I forget which underlying they were using. However, the visual representation is what's important. They show that around the 50 to 40 days to expiration is a time when theta is the highest. So the rate of decline in the option, just due to time, is highest around that time. Also, if you look towards closer to the days till expiration, you'll see that theta is also very high. So just more studies and research done by others out there in the market. Hopefully you've been able to learn a lot, and thank you for watching these videos.